Jay, what are we seeing out in the market?
All right, Chris, today let's cover the REIT. The publicly traded companies over the last couple of weeks have released their results. Let's take a little peek at some of the trends that we see there, maybe some interesting things in those reports. You and I were also, as we alluded to in the last podcast, we're pretty busy in April, traveling around the country, hosting a variety of events virtually or in person. We'll give you some highlights of some observations from that as well. And then I mentioned we traveled a lot in April. You and I are both going to Austin next week for completely separate reasons, and we'll tell you why and what we hope to accomplish. Overall, revenue growth itself is still positive. I know if you follow, like we do, the more leading indicator of new lease rent growth, that's been negative in probably the majority of markets over the last year or two, some far worse than others. Some have already trended positive. But if we look at the REITs overall, the numbers are not as negative as maybe some of the things that we've seen out there in the market, because renewal rent growth, they are still getting fairly robust renewal rent growth for most locations.
One of the other things that I noticed was on the expense side of the equation. We've heard from a number of our clients that expenses continue to be a main challenge. Certainly elevated expenses, expense inflation that we've seen over the past couple of years has not slowed the way it has on the revenue side. In a number of the REIT reports, we saw expenses more than doubling the revenue growth on a year-over-year and quarter-over-quarter basis. Yeah, I mean, you can't really look in any direction in urban Nashville and not see multiple cranes. That was really the initial takeaway, the shock. We've both been in high supply markets. Denver had a high supply boom. Dallas always has a high supply boom. But certainly Nashville is going through its supply. And we've seen that in the data come through as well. I think at one point, they had about 25%.
We are right now seeing such a different regional impact, maybe more so than I've seen in my entire career, and I've been tracking the space for 20 plus years. We're going to team up for a presentation and really take a deep dive into the labor market, which is incredibly important to the apartment industry, because more job growth means more units filled, it helps rent growth and so on. What I found really interesting when I was in that space before, because I never took my mind off apartments because I could always see how it related back. If you really want a leading indicator of job growth, talk to people in HR and talk to recruiters about how many job recs are coming through their desk. And when that number starts to fall off, the number that BLS is going to report down the road is then you'll start to see it.